Hi there. My name is Aya Yoshioka, and I'm a portfolio consulting director and senior investment strategist here at Wealth Enhancement. Thanks so much for joining me today. The S&P 500 is back in positive territory, up 0.6% year to date through May 15th. Stocks have rebounded from the lows, and we are now less than 4% away from the February 19th highs. Tariff talk has de-escalated. We're getting some positive movements on the tax front. Sentiment has come back to slightly positive. And additionally, we're at the tail end of earnings season, and we saw S&P 500 companies grow first quarter earnings by 12% year over year. A solid showing. This week, we got economic data that moved markets, including data mostly on the inflation front. We saw CPI data come in at 2.3%, helped by lower energy prices. However, if you exclude food and energy and look at those core CPI numbers, we're looking at a number closer to 2.8%, which is probably closer to what we're all feeling. But it was consistent with what we saw in March as well. We also got data on the Producer Price Index, or PPI, which tracks price changes for businesses and at the producer level. And PPI for April came in at 2.4%, down from the March reading of 2.7%. And this can indicate that perhaps some businesses may be absorbing some of those extra costs associated with tariffs, at least on some level, in order to avoid a bigger pullback in demand at a time when consumers and buyers are already feeling really uneasy about making purchasing decisions. We may not have seen the full impact of these tariffs just yet. We know we're on a pause. Some have been delayed. And we don't know if there'll be further escalation at some point or changes to a lot of the details here. We may get additional positive announcements in the coming weeks as well. But we do know that at least for now, the effective tariff rate is looking to be closer to that low to mid-teens level relative to about the 28% that was being anticipated at the height of the trade war. We also got retail sales data this week, and that showed a contraction in April, down 0.2%, and 7 out of the 13 retail categories reported declines, including apparel and gasoline. The one area that we did see a nice increase was restaurants and bars. Lastly, we're closely watching the labor market. It is our belief that as long as the labor market remains relatively healthy, the economy can experience more of a gradual slowdown, just reflecting the lack of demand related to this supply shock given the tariff situation. On the labor front, we did see the announcement that Microsoft was reducing their labor force by 3%. But we also saw initial jobless claims that were in line with last week. Looking at interest rates, the 2-year is just under 4%. And we're back to pricing in 2 rate cuts for 2025 from the Fed versus the 3.5% that was getting priced in at the peak of market turmoil. The 10-year is also back to where it started the year, near 4.5%. And gold is no longer making new highs every day, and it's bouncing around that 3,200 level per troy ounce. I think this indicates that uncertainty is no longer getting elevated on a daily basis. We're sort of finding our footing here, but it hasn't been eliminated altogether. We do think that perhaps the worst might be behind us, at least for now, but we know that things can change with one tweet or a new news headline. That's all I have for you today. Thank you so much for listening. And if you have any questions, please reach out to your financial advisor, and an investment team member would be happy to discuss markets with you. Thanks so much.